By early 2022, the cryptocurrency market ballooned into a multi-trillion-dollar ecosystem. Sitting at the absolute center of this wealth was FTX. Its founder and CEO was Sam Bankman-Fried. To financial media and high-profile investors, he appeared to be the responsible adult in a wildly unregulated room. His core product was a cryptocurrency exchange, essentially a digital brokerage where anyone could buy, sell, and store digital assets. FTX marketed itself to the public as the safest, easiest way to buy and store crypto. This chart tracks the company's valuation from its launch in 2019 to early 2022. In just 3 years, it shoots up to an astonishing $32 billion. By 2021, FTX was pulling in over $1 billion in revenue, drawing investment from venture capital giants like Sequoia and SoftBank. To buy mainstream legitimacy, they spent hundreds of millions of dollars plastering the FTX name across physical landmarks, including a $135 million deal for the naming rights to the Miami Heat's basketball arena. This overwhelming projection of size, wealth, and institutional backing successfully blinded retail investors and financial regulators to the structural risks hidden beneath the surface. Hidden behind that glossy exterior was a completely different operation, a private quantitative trading firm called Alameda Research. While the public exchange promised security, Alameda made highly volatile and speculative bets in unregulated markets, the exact risks that FTX customers believed they were protected from. Bankman-Fried actually founded Alameda 2 years before he launched the exchange, and he maintained ultimate ownership over both companies. This created a dangerous conflict of interest. The supposedly secure consumer vault and the reckless hedge fund were resting on the exact same foundation, controlled by the same group of people. That foundation cracked on November 2, 2022. The news site CoinDesk published a leaked balance sheet revealing that the majority of Alameda Research's assets were comprised of a token called FTT. FTT was a digital token invented out of thin air and entirely controlled by FTX itself. Because FTX held the supply, they could dictate its price on paper, creating an illusion of value. FTX silently siphoned up to $10 billion in customer deposits through a hidden backdoor into Alameda Research. Alameda spent the stolen funds on massive trading losses and luxury real estate, sending worthless FTT tokens back to FTX to hide the missing billions. The entire operation relied on this incestuous financial loop, destined to self-destruct the moment the market stopped believing in the imaginary value of FTT. That belief evaporated on November 6th, when a major rival publicly targeted the vulnerability of the FTT token. Changpeng Zhao, the CEO of Binance, announced that his firm was liquidating their entire position of FTT, roughly $529 million worth, citing recent revelations. This chart shows the catastrophic fallout. In a single day, the price of FTT plummets 80%, erasing $2 billion in value and obliterating the fake collateral. Panicked customers rushed to pull their money off the exchange, demanding $6 billion in withdrawals in just 72 hours. Because Alameda had already spent the cash, FTX was unable to meet the demand. In a final gasp, Bankman-Fried tried to sell the firm to Binance. Binance signed a letter of intent on November 8th, but after reviewing the corrupted books during due diligence, they immediately walked away. A company that took 3 years to reach a $32 billion valuation was entirely erased in exactly 9 days. On November 11th, FTX officially filed for Chapter 11 bankruptcy protection. Sam Bankman-Fried resigned as CEO, stepping down in disgrace. To oversee the liquidation, the court appointed John J. Ray III. He is a restructuring specialist who previously managed the cleanup of the Enron scandal. Ray's assessment of the firm was scathing. Testifying before Congress, he called the situation a complete failure of corporate controls and characterized the management as pure, old-fashioned embezzlement. The criminal response was swift. Bankman-Fried was arrested in the Bahamas, extradited to the U.S., and ultimately convicted on multiple counts of fraud, leading to a 25-year prison sentence. The collapse triggered a crypto contagion that toppled direct affiliates. Lenders like BlockFi and Genesis, which had provided under-collateralized loans to Alameda, were forced into their own bankruptcy proceedings. While bankruptcy courts may eventually recover some funds for victims, The collapse permanently shattered the myth of the unstoppable crypto giant, exposing the consequences of a multi-billion-dollar market operating without oversight.